So the dollar, still my contention. This is not the low, and we're going to go for the January lows, and it should start having some trouble around here. Last week, I showed that I thought that euro could trade down towards 120.50. Here we go. So I'm going to be interested in this area. It's going to be pretty important. We start taking out 120. There's then the dollar rally is on the way. Here's the 200-day right down here at 120. My initial expectations are that we don't get down there, that we hold somewhere around here. We did have a 2-week reversal sell in the euro. What will it take to reverse that? This week's off number in euro is right here, 120.180. So we're 70 pips underneath it. I'm thinking this is just a pullback before we get another push up, which should help accelerate the S&Ps, although they're coming off pretty good right now. Here's the S&Ps, still diverging on the weekly. On the daily, it's pretty glaring, and we're even getting some short-term divergences. We've had, all last week on the 4-hour, 2-hour, and even the 15-minute at last night's high, 42.56. But we're almost there towards month's end, a couple of weeks away. Unless we have some type of serious technical damage, I think the market can levitate into that time frame. But we'll see what happens with the Fed. We'll see what happens with infrastructure spending. In the meantime, um, still looks to me like the yen wants to make a new high up here. So that kind of favors the dollar. And really, what was interesting on Friday is that the Canadian broke out. I'm looking at SQQQ. So Canada finally on this candle started to accelerate out of this, and it's above all moving averages here. So I'd say this was really kind of a standout for the dollar um, with the turn in Canada, even though oil is still making new highs, made a new high again today over 71. So what would be ideal is maybe have some follow through to 22, 22 and a half in Canada, up around here. And then if the dollar rolls over one more time and trades under 89.20, it'd be nice to see Canada not make a new low. With that happening, not go to 118. So, there's a possibility that that's what is developing. It was the weakest thing against the dollar. So maybe it's going to be one of the stronger things once there is a dollar bottom, although I think we're weeks away and price away. I still think 89.20 gives way. This has surprised me after last week's action, and gold's at a very critical area here. So this is either just a corrective ABC here down to major support, or we've peaked. So gold has to do something to dig in its heels this week and close above this breakout line. This is the line everyone's been looking at, right? So if we're going to hold this, it's right here. Gold, good or bad, from this area within $5-10 right here. So this too is pretty pivotal this week to see if we could get an extension in the rally. And silver down pretty sharply, but holding up much better. Look at the difference between what gold's doing and what silver's doing. See? And that was accurately forecasted with this failure one more time at 68.5 in the gold silver ratio. I hope everyone has a good week. I think something to kick off your week would be to have this at your fingertips with the active patterns in play, all the great research, members chat, give yourself an edge and surround yourself. I think whether it's our community or you find another one, you need a community. And community is there for you more than a half an hour of analysis here in face. So consider it. Okay, I'll take one quick look at the SQQ. Here you go, Amira. So there's a 4 hour. So we're diverging, you know. I thought we'd come off with the NASDAQ. I'm still going to try and be patient for NASDAQ 14.3. So, you know, I still think there's a shot for 14.3. That's still another 2% higher or so. And I think there still could be another 2% higher in S&Ps. Does that help you? So I'm figuring that QQQ could trade 970, Amira, 980. Okay, take out the big round number at 10. But if you're not worried about being perfect, you know, you could start putting your toe in the water at these levels, knowing you could break another 50 cents or so on this. Good morning, Blake. How are you? Oh, I don't think Blake is here today.
Oh no, I'm here. Yeah,
okay.
Yep. Good morning.
Okay. Good morning, buddy.
Reluctantly, I'm here. I say that because A, the market's kind of slow, but B, it's because it's hot as oh my god here, and I'm sure you're feeling the same type of heat. And I just came from Flagstaff. I was up in northern Arizona, and so I did not want to leave.
I know.
Yeah,
I'm actually having a regrets. Okay.
I could get that. Hey, you were talking about gold a little earlier, and you know, gold's breaking down today. Excuse me. It's pretty aggressive. I'm actually, well, I'm surprised for a couple of reasons. I'm surprised that gold's breaking down right now, and I'm surprised that the dollar isn't seeing more upside follow through, because the dollar, if you look at like the euro, for example, we broke out of this triangle on Friday.
Right.
We broke out of this triangle channel, and we tested the 618 on Friday, and we've been kind of consolidating since then. And in my opinion, we're just forming a bear flag pattern in the euro, which makes sense considering the gold market's actually breaking down now. I would assume that the euro tries to play and follow suit here. I would assume that we start to see a move like this transpire and possibly take out the lows from Friday. But it is, you know, the FOMC is this week, so there might be a little bit of hesitation here. But I'm surprised gold is as bearish or is as aggressive right now as we're seeing. I mean, this is a pretty big move. I've you know, I've been watching it this morning going, you know, I should probably stall here. It should, you know, I keep looking at the move thinking, well, it should stabilize around here. It should find some support. Now, if you're a Forex Analytics subscriber and you see the bias chart, and the bias chart, we do it every morning, you know, during the trading week, we do it 45 minutes after our webinar, or actually, I'm sorry, 15 minutes after the face webinar is over. We go out and we do this analysis with the group. I've been writing down 1845 on gold. I want to say for, you know, I think anybody that's listening in that has been listening to the Morning Edge webinar probably confirmed like 1845. I think we've been writing down for 2 weeks, and it's big. It's big for a couple of reasons. It's the breakout point. You can see this red line here. It's also the 200-day moving average, and my opinion,
and the trend line. Well, the one everyone was looking at, Blake, from the high of the move to the secondary high was
you mean this one? Yeah, I mean, I guess we could do it just like that. The only reason why I didn't have it there and I had it a little lower is because I took the lows. So here, let me just delete this really quick. This would be the spike low here to the low to this is the channel, right? That's held
Right.
as far.
Yeah.
So now if you know,
Just clone it. Yeah.
duplicate it, yeah, it
Yeah.
actually takes us
Lower.
little lower. And so will we stop there? We could. I mean, I have it drawn like this, which I'm just going to leave it, but I do believe there's a lot of support here. And matter of fact, we could do a couple other things too. Here's your 4-hour chart, so you can get a better view of what the triangle looked like as it broke down. Right? We can do our immediate target. Will take us to 1845 or 1840. So I would be very surprised if we did not find support down here. I guess the thing that you should keep in mind is if you are short gold, you're gonna find some support down there. And if you want to buy gold because you want to buy gold, then you probably need to wait till we get down to 1840 or so before we do so. Now, there's a couple things in currencies that are happening. I know we looked at, and I was just talking about the euro, and I was just saying, hey, the euro broke down. There's a couple other big developments in the currency market that are happening as well ahead of the FOMC.
Is Canada one of them?
It is. I was sorry. I was just setting down my coffee.
Right.
It is. Look at the dollar Canadian and notice how we broke through 121.50, right? This is the channel resistance.
Right.
The range highs. I'm grabbing the wrong thing here. There's your range highs. 120 to 121.50. That range extension points to 123, right? Yeah. I mean, because this is 150 pips, 150 on top of 121.50 is basically, up to 123. So we should extend towards 123 if it plays out on the dollar Canadian. Now, we were just having one other conversation in the chat room, and let's talk about this really fast, and then I'll bring in Stelios and Steve and see if they have any opinion on this. Amanda's like, oh, I'm hearing chatter, probably from the Live Squawk service guys, and if you use Live Squawk, they have a Squawk service, and she was mentioning that there's a lot of chatter about tapering. And she had mentioned in the chat room that she doesn't believe that they're gonna that they're really gonna taper or talk about tapering. And remember, it's just taper talk. The important thing to realize is the FOMC is this week, but then we have the Jackson Hole Symposium shortly after, and the Jackson Hole Symposium. Let me get you the exact dates. Let me get you the exact dates for this year. It will be boom. Every year since 1978, and it is what are the dates? August 26th through 28th. So shortly after, the FOMC meeting, people are going to be looking towards Jackson Hole. And Jackson Hole is significant because that's where a lot of policy changes have been made or announced over the years. The Fed has used that as a platform to really be able to express in greater detail, other than just a statement or a press conference, really to utilize the Jackson Hole Symposium to express, how they want to move forward with monetary policy. So, I'm going to approach this week with, I'll probably be pretty flat going into this week as far as the dollar goes. If I have any dollars, like right now, I'm trying to establish some dollar longs, but the only way I'm going to hold on to them is if I am pretty profitable by the end of midweek. Meaning, like, let's say if you're long the dollar Canadian, that's great. If it gets to like 120, 190, we start to play out this bull flag, and you're long here at 50 or 60, then I'd be willing to take that into the FOMC, knowing that I've got 40 pips of profit to play with. But unless you have a already profitable position going into this week, into this FOMC, and you're willing to give up those profits that you have, I think being more reactionary to the market is going to be reacting to the Fed, I think, is going to be probably the wiser decision, because I don't think that I think there's going to be a lot of opinions, but the Fed has proven to be very dovish, and as of late, so they've been more cautious than anything. So Stelios, what's your opinion, if he's here this morning? What's your opinion on the Fed this week and Jackson Hole coming up in August?
Good morning, everybody.
Good morning, Stel.
Week ahead. Yeah, that's a good question. I mean, there has been a lot of chatter about the Fed mentioning tapering and all that. Yes, we do have inflation, which is ticking up, but I think we're still within the realm of what the Fed calls, symmetrical inflation target. I think they're going to wait a little bit more. Let's remember what the market's pricing. The market's pricing one hike by the end of, when is it? 22. Yeah, one hike by the end of next year, and then two more by the first half of 2023. So it's not like the market's pricing a lot at this moment. So you could say that there is a risk that if there's any kind of hawkish talk, that the market's going to run pretty quickly and start pricing more. If you ask me what I think is going to happen, I don't think that they're ready yet to say something concrete, or maybe to really hint that tightening is coming.
They're not even going to talking about tapering.
Well, at the moment it's that way. They might drop a little hint, but I don't think it's going to be something that's going to worry the market. Obviously, I've been wrong in the past, but the stuff that the Fed, the way they've been communicating recently, it doesn't look to me as if they're in a hurry to do anything. So that's what I think. But obviously, we could get a surprise.
Yeah, I mean, so I'm looking at the dollar and the way it's responding right now, and we'd talked about this last week. Like, we're going to find ourselves mid-range ahead of, and you guys should know this, and I pretty much feel this way about any key event. We find ourselves mid-range ahead of an event. So if you're looking at like the euro, for example, the range, and we actually talked about this last Monday or Tuesday, and I remember because Simon had asked about this. If you look at the range of the euro dollar over the last several weeks, the low being 120, the high being 120 to whatever 70. Mid-range is going to be 120, 120. So I'm assuming that we're going to be somewhere around here by Wednesday. We could even do something like this, and I think this is pretty realistic, actually. You see the euro people, it might actually get a little bit of a breakdown ahead of the FOMC, right? You see it break down through the 618, get everybody excited, and then get everybody stopped out who gets short, and then we pop right back up to 121 20 30 level, just ahead of the FOMC. I actually envision that happening in the euro dollar over the course of the next couple of days, just because I think that makes a lot of sense to me, that we're not really going to go anywhere, but it's going to suck a lot of people in one direction or the other. So I think you have to have your guard up ahead of this week. Doesn't it make sense, Stelios, to really wait for the Fed this Wednesday? I mean, we are at we're at an inflection point in monetary policy. So
yeah, I agree 100%. I mean,
they could go either way. Now, remember, we're not talking about the Fed is actually going to be raising rates on Wednesday. They're just talking.
First, they have to curtail some of their buying before they go that way.
Yeah. The first they even have to start saying that tapering will possibly happen, that's exactly right, Dale. They've got to talk about possibly, reducing the amount of purchases moving forward. So,
I want to ask Stel this and you, Blake, because maybe you guys know. There's two things that they do in the open market: system repos, which is adding liquidity, and matched sales, which you hardly hear about anymore. That's when they're draining. And I'm wondering if we're going to get some hints just by watching whether or not they're doing system repos, which they probably do and we don't hear about anymore. But match sales, I've seen a couple of times they've done it, and that's unusual because that's a draining of liquidity.
Well,
you guys,
what's been happening recently is we had a record number of reverse repos. So I think it was half a trillion. That shows that bank liquidity is actually not bad. And remember, this is basically the banks offloading their excess reserves, which they cannot lend out. So they don't know what to, not they don't know what to do it, but they have very few things that they can actually do. And one is depositing it with the Fed. Yeah, exactly. Okay. And getting whatever the Fed gives them. So, which is a few, I don't know actually what the rate is, but
so they're kicking back liquidity. They already have too much.
At the moment, it looks that way. Yes. So a couple of years ago or last year, we had the opposite. So they were, the Fed's repo operations were massive. So it was the opposite. So
end of 2018 when the repo market seized.
Yes. So at the moment, we don't have any of that, or at least we don't seem to.
Okay. Thank you, buddy.
No worries, man.
All right. Well, we just heard Steve. Now, Steve, I got to ask you. How was your birthday over the weekend? Happy birthday, Steve.
Happy 50th.
60th, you mean?
Happy 60th, Steve. What is this the big 40 this weekend? Or was it this weekend?
41.
41. Okay. See, I can never cut. I never 41 years young. Happy birthday.
Yeah. Feels 41 years old, but sure. Thank you.
Well,
happy
Steve,
birthday, buddy.
You had a great weekend. Now, do you have any thoughts ahead of the FOMC this week? I know your opinion is the Fed's never going to raise rates.
Me, I'm boring. No, I do believe they're going to raise rates.
But let's also understand the fact that the market doesn't need rates to actually go up. The markets start to get more volatile and currencies start to get more volatile just with the thought and the idea that rates might actually move sometime in the near future, within the next couple of months. B, there starts to be divergences between central banks and where each central bank is at versus another. So the heightened risk of increased volatility moving forward, just with the idea that the Fed might actually consider raising rates over the next few months is an actual thing, which can create some volatility. So again, what are your thoughts here?
First of all, I heard Stelios before, but I got a phone call like a few seconds afterwards. So I couldn't comment on that. Stelios said that the Fed is still within its mandate of 2% symmetrical target. I'll have to completely disagree with that, because so far, a few days ago, we got May data. So far we have data for the first 5 months of the year, so 7 left. And so far in the year, we've seen 2.7% inflation cumulative so far. So we've already exceeded 2% substantially. Somebody could say that 2.7% could be within the mandate of 2% symmetrical inflation if we currently were at January of 2021, and the 2.7 was the inflation data that we had for the whole year. Now, what we know is that the pace of inflation is, if we continue in this pace for the rest of the months, we're going to have inflation above 6%. Now, I don't know exactly how the Fed can excuse an inflation print of the year that's going to be above 6. Let's hope it slows down and let's say it's going to be 5. Sure. I don't know exactly how they can excuse that as symmetrical target to 2%. But I don't think there is any way they can make this fly, right? Now, I have no idea when the Fed is going to decide to raise rates. I have zero clues. The only thing I'm 100% sure about is that whenever they decide to raise rates, be it in 2 months from now or in 1 year from now, they're going to be dramatically behind the curve. And that's all that matters. It's less important if rates are going to go from 0 to 0.5% or 1% or whatever. More important is, are they behind or in front of the curve? We know that they have absolutely no intention to ever be in front of the curve. The question is going to be, how much behind are they going to be? My assumption is dramatically behind the curve, and that's all that matters.
All right. Well, you know, that if they may be behind the curve, but then, you know, for volatility reasons and for the markets.
Exactly. That's what they care mostly about, to be honest.
Yeah, because
asset prices being stable, you know, and markets being contained. That's all they care about. The rest is, they claim they care about the rest, but in essence they don't. And how do we know they don't? Because it's more than clear what kind of events and data are the ones that actually make them react. And so far, what we've seen during the past many years is that they only react to things that make the markets volatile, nothing else.
Right. And so now let's talk really quick about the things that they may react to or may not react to. I mean, we have the S&P that continues to be, you know, right up against the all-time highs. I mean, we are just nudged right up against all-time highs. How do you feel about where equities are at now, currently? Hello.
Say again, Blake. Sorry.
Oh no, we have stocks that are at all-time highs. You have the S&P that's just nudged up against all-time highs.
Yeah.
Here, how do you feel about where equities are at, and do you think the Fed will even care about asset prices where they're at right now?
Oh, I think they care about asset prices at any given moment in time, and the reason they do is it's not that they would mind it so much or that it would derail anything really if equities were like 15% lower. The problem is that when you know that the whole construct of a functioning economy is based on asset prices, you're extremely scared that any type of sell-off can evolve to be something more than what you want it to be. That's why I believe, oppositely from inflation, they're extremely reactionary, having to do with what happens to asset prices. So I don't think they would mind so much if assets were like 10, 15, 20% lower, but they want to make sure that this will not cascade.
Right. Okay. Well, very good. Well, Steve, thank you for your thoughts. I know it is time for Dale to do his interview. Guys, if you haven't tried out Forex Analytics, make sure you do so. It's only $1 for 10 days. Try it out. Download the mobile app. Come join us in the chat room. This is what our chat room looks like. You can see just all the conversations that have been happening just while we're all sitting here chit-chatting. Anyway, I'm going to put that back over here. And Dale?
Yep.
I'm going to hand it over to you. Thanks for being here. Stelios, Steve, have a great day. Guys, if you're in the Forex Analytics community, I'll see you in 45 minutes on the Morning Edge.
Okay.
Who do we
you,
have,
Blake.
Dale, today?
Fred Jeans, and I'm assuming Frederick Lindstrom is him. So I'm going to make him the panelist.
Okay. Thank you all for your wishes, by the way.
Oh, next year I'll sing it to you, buddy. I didn't know, or it would have been done Friday. So Fred Jeans, welcome to Face. That's right. I invited you. All right. So I made you a panelist. Oh, you're not my guest. Okay.
Surprise,
All right.
surprise.
All right. Well, then, Steve, I have a no-show.
Okay. Okay. Are we sure you want to like?
I sent him messages already. So,
Okay.
I, I should have figured it was, anyway, it's a no-show. It looked like
Okay then.
Fred Jeans, are you here? Send me a message. Frederick, you want to be my guest today? You're here in Face. Okay. I thought I'd give it a shot. You want to talk about your journey in trading? Okay. All right. So Steve,
We have,
guess-
by the way, one phone call listener in case.
yeah, maybe that's what happened. Anyway, Face, my apologies. I can't control what other people do, but we have some great stuff the rest of the week. So Nick from In the Money Stocks, which are plenty of, will be with us tomorrow. He's a GAN guy. And Steve, extend your birthday. Really hope that this is one of your best years in every way.
Thank you, Dale.
Okay, and
Same to you and everybody else.
yeah,
Let's for sure hope it's going to be a better year than the past 12 months.
Well, yeah, the past 12 months has been a challenge, and
They have.
Anyway, and you had your challenges on-COVID related, and I'm just glad our whole team is healthy and whole through this crisis, and we never stopped all the way through trying to do our best to guide people through these wild market, unusual Twilight Zone times.
Indeed.
So, okay, buddy. So I'll talk to you tomorrow.
Okay. See you in 40 minutes.
Join the team and for Morning Edge, and you have 40 minutes right now to subscribe and see get prepped for the whole week with Blake and Morning Edge with the bias chart, etc. And plus, all the great features of Forex analytics, watching Grega's stuff, and keeping an eye on Andre's harmonics, and really,
Or
getting
they can take
data
advantage of that time in case they haven't. Now that you mentioned Grega, Grega did this week's week ahead video because Blake was traveling. So if you haven't watched the week ahead video, it's you have a nice opportunity time wise to visit the YouTube channel of Forex Analytics and just watch it. It's a nice start of week preparation.
Simon saying you'll be signed up ahead of FOMC, and he calls being a member gold dust. So I hope you're hedged on your gold dust today, Simon. And remember, everyone, don't just count your pips, count your blessings. Be careful this week with the Fed. My philosophy of being flat into a major event and then reacting to the Fed. So maybe we'll have a little bit more of an eyeball going into it and be prepped for after the Fed for executing. You do your work beforehand, and then if the market reaches a critical technical zone for you, then you're ready to execute instead of analyzing on the fly.
It's the old adage that says, plan your trade, trade your plan, right?
Right, and plan your trades for after the Fed, and then there should be some clear sailing into month end without anything major. So I think there are, I don't know, Steve, what your thoughts are, but I would be looking to fade dollar strength on the Fed.
Yeah, I think the Fed is going to keep surprising to the dovish side. I mean, even people that realize that the Fed is dovish, they have some kind of expectation, that at some point, this dovishness has to be diminished. And I believe that the Fed is going to keep surprising to the downside. That doesn't mean, as I said before, that the Fed will never hike,
Yeah.
but it means that even when they do hike, they're going to be doing too little, too late. So
And technically, I don't know if you believe it, but even to have a real good bear market rally, I think they have to clean out the January 89.20 low before we could get anything going to the upside.
Very, very likely. I mean, sign me up for bearish downside targets in the dollar. I've explained why I'm so bearish the dollar a very, very long time ago, and the fundamental reasons that made me be bearish have not only gone away, but they've become bigger than even I would have thought. As simple as that.
All right, buddy. Good banter, and we'll see everyone tomorrow. Good hunting the rest of the day, and sign up
Bye-bye,
and get
everybody.
Morning Edge. Thank you, Steve.
Bye-bye, Dale. Thank you.
Bye-bye.